The morning star is a three-candle bullish reversal pattern that appears at the end of downtrends. Despite its popularity, traders frequently misuse this pattern. Some common mistakes are entering too early. Many traders enter positions immediately after the second star candle without waiting for confirmation from the third candle. The pattern requires the third candle to close above the midpoint of the first candle's body to confirm the reversal. Ignoring volume. Trading the pattern without volume confirmation significantly reduces its reliability. The third candle should show increased volume to strengthen the reversal signal. Wrong market context. Using morning star patterns in sideways or consolidating markets instead of defined downtrends reduces effectiveness. The pattern works best when it appears at the end of a clear downtrend. Poor stop-loss placement. Setting stop-loss orders too close to the second candle's low makes positions vulnerable to normal market volatility. Stops should be placed below the low of the second candle or third candle if it's lower. Trading in isolation. Relying solely on the morning star without other technical indicators or market context analysis leads to false signals. The solution would be to only trade morning star patterns that check all your boxes. You want to wait for the third candle to close above the first candle's midpoint on rising volume. Make sure it shows up after a clear downtrend, not in choppy moves. Also, set your stop just below the lowest low of the second or third candle, and always back it up with at least one other indicator. The bullish engulfing pattern consists of a small bearish candle followed by a larger bullish candle that completely engulfs the previous candle's body. The common mistakes include trading without context. Using the pattern in isolation without additional confirmation is problematic. Bullish engulfing patterns only succeed approximately 55 to 63% of the time. Ignoring market trend. Trading bullish engulfing patterns in strong downtrends often results in weak, short-lived reversals. The pattern works better as pullbacks in uptrends or at significant support levels. Premature entries. Entering immediately after the engulfing candle closes without waiting for confirmation, such as price breaking above the candle's high, leads to frequent false signals. Lack of proper confluence. Overlooking key factors like support and resistance levels, trend lines, RSI or MACD signals, moving averages, and volume reduces signal validity. And poor risk management. Failing to set appropriate stop-loss orders below the engulfing candle's low or not defining risk-reward targets leads to inconsistent results. To fix this, always treat a bullish engulfing as just one clue, not a sure thing. Only trade it in an overall uptrend or at a strong support zone. Wait for the next candle to clear the engulfing high before jumping in, and look for backup from things like trend lines, moving averages, etc. as mentioned before. Then lock in your risk by placing a stop just below the engulfing low and aim for clear profit targets. This way, you blend context, confirmation, confluence, and proper risk management into every setup.
Nice.
The Harami pattern is a two-candle reversal formation that consists of a large candle followed by a smaller candle that fits entirely within the body of the first candle, suggesting potential trend exhaustion and reversal. The name Harami means pregnant in Japanese, referring to how the smaller candle appears inside the larger one. This pattern shows that momentum from the first candle has slowed, with the market becoming indecisive. These are the common mistakes you should avoid. Ignoring market context. Trading Harami patterns without considering the overall trend reduces effectiveness. The pattern works best as a bullish reversal in downtrends or a bearish reversal in uptrends. No confirmation. Entering trades based solely on the Harami's appearance without waiting for additional confirmation, such as a candle close beyond the pattern's high-low, leads to false signals. Volume and structure neglect. Ignoring volume analysis and not examining the size of the second baby candle. Small inner candles often indicate weak reversal potential. Risk management is also important on this one. Inadequate stop-loss placement and ignoring position sizing rules undermines trading discipline. Premature entries. Acting immediately without waiting for follow-up confirmation reduces success rates. Here's what you can do to solve this. Only trade it in the right trend. This means to buy in downtrends. Sell in uptrends, but you should wait for the next candle to close beyond the pattern's high or low before entering. Also remember to check that the volume backs up the move and that the baby candle isn't too tiny. And always define your risk by sizing your position properly and placing your stop just beyond the outer candle. Pin bars, also known as Pinocchio bars, are reversal patterns that feature long wicks or tails extending at least 2/3 of the entire candle's length, with small bodies positioned near one end of the candle. The long wick shows that price moved significantly in one direction during the session but was rejected, with buyers or sellers stepping in to push price back, creating a potential reversal signal. Remember to avoid these mistakes. I've seen a lot of traders make them. Pattern misidentification. Not every long wick candle qualifies as a pin bar. The tail must be at least 2/3 of the entire candle, with a small body near one end. Entering immediately after the pin bar formation often results in poor timing. Wait for confirmation, such as a close beyond the tail or follow-through candle. Also, using pin bars against the dominant trend is unreliable. These patterns often act as continuation signals rather than reversals. Trading pin bars that appear randomly in price action rather than at key support resistance levels, trend lines, or Fibonacci levels reduces effectiveness. Low volume timing. Pin bars forming during low volume periods or after sharp moves are often just profit-taking signals, not genuine reversals. Let's see how it should appear on a chart. You should only trade ones with at least 2/3 of the candle as a tail and a small body tucked at one end, and only when they pop up at major support, resistance, trend lines, or Fibonacci zones in the direction of the main trend. Wait for the next candle to close past the tail or show clear follow-through before pulling the trigger, and avoid pin bars born in low-volume lulls or right after sharp moves, since those are often just profit-taking, not true reversals. Hammer patterns appear at the end of downtrends and signal potential bullish reversals. They have small bodies positioned near the top of the candle, little to no upper shadow, and long lower wicks that extend at least twice the length of the body. As seen above, the long lower wick shows that sellers pushed the price lower during the session, but buyers stepped in and drove the price back up, closing near the high. Look out for these common errors if you trade the hammer. The first one is mistaking any lower wick candle for a hammer. True hammers have specific proportions: small body near the top, minimal upper shadow, and lower wick at least twice the body length. But entering immediately upon hammer appearance without waiting for the next candle to close above the hammer's high frequently results in losing trades. Don't use hammers outside of downtrends. That reduces their reliability. Hammers signal potential reversals within existing downtrends. Using the wrong time frames. Using hammers on very short time frames, for example, the 1 to 15 minute chart increases noise and false signals. Higher time frames provide more reliable signals. Let's watch the hammer in action. You want to only trade true hammers on higher time frames in a clear downtrend and ideally at a support zone. Wait for the next candle to close above the hammer's high before entering. Look for backing from volume or indicators like RSI or moving averages, and always place your stop just below the hammer's low with a defined risk-reward target. This ensures proper pattern ID, trend context, confirmation, confluence, and risk management all in one setup. Shooting stars appear after uptrends and signal potential bearish reversals. They have small bodies positioned near the bottom of the candle, long upper shadows that extend at least twice the length of the body, and little to no lower wicks. The long upper shadow shows that buyers pushed the price higher during the session, but sellers stepped in and drove the price back down, closing near the low. The mistakes I see most often are entering immediately after seeing the pattern without waiting for bearish follow-through. Confirmation requires a subsequent candle closing below the shooting star's low. This pattern only works reliably at the end of sustained uptrends. It's less meaningful in sideways or range-bound markets. Low volume on the shooting star day weakens the bearish reversal signal. Look for volume surges and confluence with resistance levels. When trading, only trade shooting stars that follow a clear uptrend and form at major resistance. Make sure the candle has a long upper wick with a small body at the bottom, and wait for the very next candle to close below its low before entering. Double-check that volume picked up on the shooting star day and you're on a daily or weekly chart, not a noisy intraday time frame. And always place your stop just above the high with a defined risk-reward target. Remember, these candlestick patterns fail not because they're inherently flawed, but because traders misuse them. You need to screenshot or write down these key takeaways. Now that you understand why these patterns fail and how to fix them, there's one more piece of the puzzle that can dramatically increase your success rate with every single one of these setups. There's a specific indicator that acts like a filter for all candlestick patterns. It helps you separate the high probability trades from the traps. When you combine this indicator with the corrected approach I just showed you, your win rate on these patterns jumps significantly. That's why you should watch this video next, because I break down exactly how this indicator works and show you live examples.